Now we're going to turn to the normal overview and again try to tie it back to what is happening with Colonial. What does it mean for some of these pricing in general? So when we look at the futures curve, clearly we continue to move up and to the right. The EIA has taken up their estimates and taking up some of their demand estimates, taking down some of their supply estimates, and we'll talk about that more in segment 3. That has effectively moved the belly of the curve. You can see that has now moved on that green line to the yellow line. You can see that we've continued to shift up. We're now above 55 well through 2025. So clearly this is just continuing to shift things up in general. At the very front of the curve, we're starting to see a little bit of softness, but obviously now, depending on where things are going to go, and slight backwardation depending on what time you look at it, because it's kind of waffling right there. But that's where we're starting to see some friction. But just across the curve in general, we're continuing to see that move up. The estimates continue to remain robust, which is what is really driving some of that in general. When we look at COVID overall, and this is going to give some of those data points, COVID has become a big issue again, or a rising issue again within Asia. Obviously, those that have been following India remains a big issue in general. Luckily, so far, they've slowed down a bit. We'd like to see this trend continue. But again, this is going to be the one that is going to impact demand the most for the remainder of May based on what we've already seen. Now, on the other side, you have Japan, Malaysia, South Korea, specifically Japan and Malaysia, which is where we've seen some of the biggest reductions on movements. And then on the positive side, when we look at Europe, you can see France, Germany, Italy, continuing to roll back over. Europe in general continues to roll over. Now, that is a net positive. So then when we look at Western Europe toll road usage, it's the highest in months. So Italy traffic was 13.8% below 2019. Spain was down 19.2%. France was down 10.2%. So you're still down, but you're now starting to close some of that gap. The biggest issue in general is Spain, because Spain has had the least amount of impact and have been reopened the longest, but we're still at that depressed level, even though things are getting better, the factor that we keep talking about is that it's not going to get back to where it was, because we still see some of these headwinds. Even though things have gotten better, COVID won't be the issue, but there still remains an economic reason and an economic pain point that is keeping people from getting back to that normalcy. Now, just from the EIA, world oil demand for 2021 was revised down to 96.4 from 96.7. India's demand to fall 825,000 barrels a day. I'm sorry, this is from FGE. Month over month in May, we have that a little bit higher, but again, it's going to come down to how quickly do we see some of that normalcy. Indian reductions concentrated on 2Q, and the non-OPEC supply of 2021 little changed, with demand for OPEC plus crude in June to December seen higher than OPEC plus supply, which is the key factor where we're the view is that we're going to see that supply continue to dwindle, demand continue to move higher, but as we have been highlighting in general, the physical market, the Asian market is the one that gives us pause when we look at some of this quote unquote normalcy. So then when we turn to the U.S., the U.S. had a draw of 430,000 barrels. This is where it's going to get a little backwards when we think about what is the Colonial Pipeline going to do to oil demand. It will, in the near term, impact crude demand, especially in PADD 3. So we would expect to see an increase in crude builds over that time period. Now, as we've been saying, the pace of draws was going to be nominal. It was going to be very slow. That remains to be the case. And because it remains so slow, we expect to see a little bit of a pivot higher. We're not saying that we're going to have these 7 million barrel builds, just that we're going to see this steady increase of anywhere 500,000, 1.5 million as we see some of that shift higher. You can see once we factor in the SPR, there was a draw of 1.83 million. That will continue just because there's more tenders out there that go through June. So we will continue to see the SPR being sold down, and that again is going to be a factor to watch. But commercial storage will start to flatline and creep higher over the next 2 weeks. When we look at the 5-year average, oil is 18.7 million barrels below the 5-year. But on pad 3, it's 18.1 million above the 5-year average. And that's where we're going to see that big pivot, because the pad 3 is going to continue to see some of those builds. Cushing drew 420,000 barrels. It's 10.4 million below the 5-year average. But again, that flatlining aspect is the one that continues to be some of those levels. Then production was up 100,000 barrels, but again, we already think it's over 11, not by a lot, but we already think that we're past that 11 million mark, and then just by the end of May, beginning of June, we're going to start seeing some of that additions to the upside as some of these frac spreads, as they complete their work, turn the well on to market. We're going to see this creep higher. Again, we're not saying we're going to 12.5 million by July. It's just going to be that steady grind higher now that we've arrested those decline curves, and then start to drive higher. When we go abroad, stockpiles fell 6.9 million to 657.2 million throughout known commercial storage. Floating rose 1.9 million to 107.3 million. The difference when we look at land storage, so we look at West Suez, the U.S. and ARA, so net they had a build. So we had if you want to think about a counter-seasonal build, when you look at the 5-year average and when we start to roll over. It's small when you factor in what the U.S. did and what the ARA had. Again, just more of a sideways move. And you can see in the East Suez, you're starting to curl up a bit. And that's where we continue to see some of the biggest headwinds in general, specifically when we look at Shandong and Japan, where we're seeing some of those builds continue into the market. So East of Suez is the one that we think is going to be the biggest overhang, as things in West of Suez just essentially flatlines in general. And you can see just the million barrels, just a pretty chart showing kind of where we sit versus normal. And what is normal, whether you want to use the 5-year average, days to cover things look a bit worse. I would say that that's probably a better way to do things. And by worse, I mean not as bullish, just based on the amount of product that remains in there and where demand should shake out over the coming days. Now, the one thing we just wanted to look at is road congestion, airport, subway. So this is the China high frequency data, because you can see that through May, you got back to the 2019 average because of the May Labor Day. But as soon as that Labor Day is over, and mind you, there was about 300 million trips that were done for that holiday. And even with that surge in activity, you only got to 2019 average, and now you're back below that as people get back into some sort of normalcy. This is that headwind where when you look at China and you look at Asia in general, so China's been open the longest, has, depending on whose numbers you believe, I'm like, that's not an argument I'm going to have right now. But China's had some of the lowest impacts from COVID, but yet they're only back to this level of road congestion. And again, these are the issues that we continue to see. And this is on an economic level. And in this coming Econ show, we're going to talk about what does that mean and what are we seeing for stimulus in general, because they've actually pulled a lot out of that capacity. And then when you look at airport departures, even with May activity and that Labor Day, we did not see airport departures increase. Subway rides did. And this comes back to people are still staying local. We're still not seeing this huge surge of activity. And unfortunately, this is what we think is going to be more of the norm versus the abnorm when we look at other regions when they begin to open, or I should say progress through the reopening phase. So just to highlight India in general, India's use of oil products last month fell to the lowest since September. As the second wave of COVID pushed through, India consumed 17 million tons of oil product in April compared to 18.78 tons in March. Changes in demand, gasoline was down 13%, diesel was down 7.5%, naphtha was down 6.5%, LPG was down 6.5% as well, and then pet coke was essentially flat. So as we were saying, on a percentage level, gasoline was going to fall the hardest just because it recovered the most. So month to month on a percentage, it looks worse. On a tons side, it's down to 2.38 million tons, where diesel recovered the least, so fell the least, and it fell that 7.5%. But that comes out to 6.68 million tons. Again, these are the problems that we continue to see throughout the system in terms of getting to some of that normalcy. Now, said a different way, when we look at Europe and the rest of Asia, so this is showing you that surge for Labor Day, which is now reversed. When is this struck? So when you look at when this is struck in general, this is only to May 5th. So you can see that picks up the back end of people getting back from Labor Day, where Europe has essentially come down a bit. It has rallied since then. So it's still back towards that high, but rest of Asia has continued to get worse. And that's not something that we don't think it continues to get worse. We just think that it's going to hold this level and essentially go sideways now over the next 2 weeks, just based on the renewed restrictions that we're seeing as North America continues to trend higher, especially as Canada comes back and we have our normal seasonal push. So now getting to the total inventories, when we look at the U.S., you can see, again, this kind of flatlining side. We typically have builds that start to draw down as we get through the back of May, again, summer demand season. Instead, we continue to go sideways, which is what we continue to believe, where the rate of change is still going to be very low. It's just going to be slightly up instead of slightly down. And that's just going to be, again, looking at that oil demand side and where we continue to see some of those movements. Now, the updated data in general. So right now we have 2 European tankers that have changed course as of right now. So again, I just get alerts as we go through. So this is where we're continuing to see this shift. Another 2 of them moved in general. That again, we had already factored it in these 2. It's just going to continue to compound on itself as the movements come through, as that continues to open, and we see those levels accelerate. Now, when we look at Cushing, here you can see, just going back over the last 15 years, we normally have builds up until this point, and then we start to see these drawdowns. Just based on the problems in Pad 3, it's going to reverberate back into Cushing. We're not going to see massive builds. It's just we're not going to see big draws either. If anything, we're going to see slight builds that it will continue through Cushing. This is going to, again, reverberate back through the system. So then when we look at imports did not rise all that much. We were expecting to see more out of coming into Pad 3. That has since been delayed, and we'll talk about, because there was actually a big push on refined product exports, which hindered some of these movements. Again, this is something where we're going to continue to see this accelerate over the next few weeks. Imports in general are up 37,000 barrels a day. That's still 1.9 million off the 5-year. And it was really driven based on the lack of Pad 2, 4, and 5. Now, Pad 5 is the difficult one because of all the supply issues and the delays in that region. So we will start to see that pivot up a bit. Pad 3, we're going to see some slowdowns. And in Pad 1, we should see an increase as they try to pull in more crude to accelerate runs. And so realistically, we should see a net, essentially flat 5 imports, because these are fairly low for this time of year. We would expect this to be higher. So because it's still so depressed, we think it's just going to be flat on a week over week level. Then when we look at runs, here's where we're starting to see some of those impacts. The total utilization rate was down to 86.1% from 86.5%. We had already expected a small decline, not a huge decline, but we did expect some reduction. Pad 3 reductions will remain in place, just because they're 262,000 barrels now below the 5-year. And the reason why, not only because they reduced their throughput, but on a seasonal level, it's going to get the comps are going to get harder, because they typically start to accelerate as we go through Memorial Day into the end of May. And instead, we're not seeing that. So Pad 3 will remain down. Pad 1 will accelerate. So that will be some offset. So we do think that there will be another movement lower in utilization rates, but not a huge number at all. If anything, 85.5, because some of the impacts that happened Saturday and Sunday, some of that was picked up, some of it wasn't. So that's that residual, where Pad 1 still hadn't really reacted, and we think that's the reaction is going to be there. Now, when we turn to implied demand, gasoline demand fell 64,000 barrels. We were expecting it to go to 8.9. Instead, it came down to 8.8. That's 237,000 off the 5-year average. We'll talk about that more in the next segment. And because this is a calculated number and because of Colonial, that number is going to go higher. It doesn't mean that we're going to stay at that level. It just means that a lot of this pulled forward demand. And let's be fair, if you're concerned about getting gas, you're going to drive less to preserve that tank. So just think about what that's going to do on the back end of this after we get this big bump. Then we'll get this drop off, and then that drop off will remain a little bit longer than it should because of that concern as people try to adjust this. And now we have the national gas price average over $3. This is going to again limit some of that demand. Now, others will say that we need to get closer to 350 to see that adjustment. My pushback is because of COVID, because of inflation elsewhere, lack of wages, lack of jobs, and I shouldn't say lack of jobs, lack of people wanting to get jobs, that's limiting that's increasing the damage that a $3 gas price would do versus other periods of time. And again, these are some of those residuals. Disti had that fall that we were expecting of 157,000 barrels a day. We're what's the best way to put it? EIA is good for trend. It's again, calculated numbers are one thing. So we always try to use this for trend. Where's the trend going? We think that this is kind of the right spot. Now we're going to start to go higher. Jet fuel had a little bit of a recovery that we were expecting to that. It was up 198,000 barrels to that high point of 1.28, 1.3. That's where we think we'll start to roll back down now. And then on the other side, propane came down 718,000 barrels a day. That's something that will pivot back up. Again, some of that back of that timing side. Now, just looking at implied demand, touching back to Europe. So European imports of clean product from the Middle East more than doubled in April with more to come. And now a lot of this is going to start to pivot into the U.S. as it gets resold and pushed back into the market just based on where some of these data points are showing and what that demand really looks like. So then when we look at it a bit differently, floating storage for crude and PADD 3 trended up. This trend will continue higher, again, just coming in the bottom end of that cloud, not closing the gap by any means, but again, staying depressed, but the rate of change being a net positive. Imports continuing to be well below normal. This is something where we think it's going to go sideways as they adjust some of their runs, just given the issues that they continue to see within the underlying structure. Then when we look at PADD 2 actually, so when we look at the seasonal norm is a drop, but this drop, again, we try to talk about rate of change, was very high. And this is when we shift over and look at what's happening in Canada and Alaska, we're actually seeing a big increase in exports to China. So when you think about money in general and spreads, they're getting incentivized to go further west. And again, this will shift. We'll see an increase in imports, but it won't be as aggressive as we were expecting to get back above that 5-year average. Instead, we're expecting to get back to the 5-year average. That could accelerate just because PADD 2 has the ability to ship, whether by barge or by truck, into PADD 1 and into some of these shortfalls. So we could see PADD 2 refining also accelerate, which would bring this up more than what we're expecting so far this week. Here you can see the utilization rates paring down a bit. When we look at that 29-year average, you can see the trend is typically higher. Obviously, because of what has happened, this is going to continue to go sideways as we continue to see demand remain lackluster, even though, again, we are in the reopening phase. This is the reopening. We're still not really seeing some of that pull through, which, again, is leading to some of the sideways action on the refining side, just because there's no incentive to really pull forward. Now, this Colonial is going to throw a new wrinkle into that. But in the next segment, we're going to go deeper into that refined product side and what are going to be some of the reverberating issues throughout the system and what's that going to do to pricing, imports, exports over the coming weeks.